All right, let's turn to our task force as we await the Fed's rate decision this afternoon. Joining us now live from Dallas, Bob McTeer, former Federal Reserve Bank of Dallas president, distinguished fellow at the National Center for Policy Analysis. Rick Santelli is at the CME Group. Steve Leisman joins us on the set. I'll get to those two in a second. I don't know if they've met since that rumble in the jungle last week. Have you guys seen each other since then? Thrilla in Manila. Good ratings for that. Have you seen Rick since then, Steve?
No, I have not.
You have not. This is the rematch. This is the rematch. You can decide who's good, bad, or ugly. Let me get to Mr. McTeer first. Have we ever seen we're going to cut rates by half today, Bob. Have we ever done that before?
We've cut them by half. Well, no, I see what you mean. 50% of the total. I doubt it. I doubt it. Not in one fell swoop.
Monumental. Everyone's saying that you got to pay attention to the outlook and to the comments. I guess that's true, but in the past we used to decide what their bias was. Have they stopped? Are they going to revert? You know, what are the choices? You got 50 more basis points. It doesn't seem like there's that many interesting things you could say in the statement, but I guess there are about inflation or deflation or whatever.
I think the interesting thing about monetary policy, which may be addressed a little bit in the statement, is that it's beginning to matter more what the Fed buys to expand money and liquidity than how much is expanded. They've started buying other than Treasury bills to unfreeze some of these markets. And I think that if they will continue to do that, it will be good.
Hey, Bob, Steve Leisman here. A question for you, and you look at, and I guess this goes to Rick as well. As the Fed cuts rates, the Treasury yield drops, and the spread to other components or other fixed income instruments continues to rise. My question is whether or not the Fed is actually keeping pace with monetary conditions, in that if it cuts 50 and the relative spread from the Treasury to, say, corporate lending prices is the same or even goes up, then monetary conditions actually get tighter. What is your gauge as to whether or not the Federal Reserve is actually keeping pace with what's happening in the private sector and really actually loosening up monetary conditions?
Well, if I agreed with you that lowering rates makes it tighter, I'd have to say we ought to raise rates today. So I have a hard time going there.
I'm not saying that, Bob. Yeah. My question is whether or not it's actually keeping pace with it, with what's happening.
Well, I think pretty much. You know, everybody talks about the expansion of the Fed's balance sheet and what it's doing to money and so forth. That is very new. That only started in September. We had almost a year of flatline money growth, and they pulled out all the stops around September the 1st and did some catch-up, I think. I think you could almost describe monetary policy as tight before the 1st of September.
Steve, can I say something,
go
Mr.
ahead,
Steve?
Rick.
You know, one thing we need to pay attention to is that when the markets were left to their own devices, whether you agree they should have been or not, the amount of risk that separated, and the reason we use treasuries as a comparison, was best credit against lesser credits, and those spreads meant something because the market forces created those spreads. Now, with the involvement of the government, one could argue it's almost more appropriate to look at the actual level of corporation could borrow at, because the Treasury side is getting distorted, so it makes the spread maybe not as enlightening. And I'll take it a step farther. And this is kind of the epiphany I had this morning on my way in. You know, when the dollar started to weaken, right about the time quantitative easing was being Googled by all our viewers a couple of weeks ago. And I've thought all along the dollar was a very objective way to handicap who's dealing best with the credit crisis. And I think that the behavior in the dollar, the quantitative easing, the story maybe oversimplified in the journal about the lost decade in Japan, connect the dots there. I think the market is now handicapping European forces, and Trichet said buying directly isn't in their menu at this time.
I kind of wish I understood all of that.
The Fed buying securities directly is getting a no vote from the dollar market, the foreign exchange, and I think they're pretty smart.
Yeah, but Joe, Rick, the dollar has hung in there incredibly well over this period of time.
You know what? All that's old news. Look at the last 2 weeks. I'm talking about the last 2 weeks.
Yeah, it's down 2 basis or 2 points on the DXY. Rick, while the Federal Reserve
It's at
and the
82,
Treasury
it was at 88.
have
That's
said,
a huge move.
Rick, while the Federal Reserve and the Treasury have said they're going to issue hundreds of billions of dollars of Treasury securities to pay for the bailout.
That's
so
not, I think, why it's moving
to
down.
my mind, and also,
quantitative
Rick,
easing. Let's stick with my question.
Well, Rick, there is no quantitative easing going on out there in terms of Japan.
What about the mortgages? Are they buying MBSs?
Did you come in looking for a fight this morning, Rick?
No, I'm not. But are they buying MBSs? I'm not trying to fight.
They are not buying MBSs.
They've never bought. You know what? Look, they have. They did them in October. They did them in November, and they're doing them now.
Hold on. Let's go to Bob, because what the Federal Reserve did, Bob, so far is say they were going to buy MBS. That's what the Fed did. Okay, they went out and actually bought debentures from the agencies. And it's interesting, Bob McTeer, when you look at what the Fed did, is by announcing they were going to do something prospectively, they effectively let the private sector take the profit on that move and let the private sector work. Is that the right way to look at that, Bob?
I think so, but I agree with Rick. I thought they, after a couple of weeks lag, did go in there and buy some, but it may have been just debentures.
They did. They bought actual MBSs starting in October, and in the second week of November, they gave us the amount.
Maybe the Treasury did.
The Treasury
but
did,
the Fed's program, which is going to buy $500 billion of the stuff, is not up and running yet.
But it doesn't matter. Let's get to the premise here so we can have viewers have more information, get Mr. McTeer's opinion. What I'm saying is that by the Treasury, any quasi-government agency going in and directly buying securities might be a boneheaded way to go. Look at the lost decade in Japan and look at the dollar's behavior since this has become a hot issue. That's all I'm asking.
Bob?
Well, I think these are extraordinary times that call for extraordinary measures. And I think maybe Japan wasn't aggressive enough early enough. And I think the Fed has been pretty aggressive pretty early. They were off to a slightly late start. Let me get myself in trouble here again. You know, we've got consumption declining. Investment was flat, but it's probably going to decline as long as consumption keeps declining. The only private sector spending we had going for us was net exports. And this recent turnaround in the dollar, recent appreciation in the dollar, threatens that. So that takes out all the private sector support for the economy, and it leaves the government spending, fiscal policy, with the whole burden of turning the economy around. So I don't think the dollar appreciation right now is all that helpful.
I think that's an interesting point. I don't think the dollar has really been that much of a key, as Rick has said. There were people before who said it was time to defend the dollar, and that was the exact wrong policy at the time it was mentioned, Rick. The other thing, though, is that I think the difference between what the Federal Reserve is doing and the Bank of Japan did is the Bank of Japan was targeting a reserve level in the banking system. The Federal Reserve, we don't know quite yet, we may get some information on that today, looks to be targeting specific interest rates in the economy. Let's leave it there.
Looks to be.
Well, we don't know. We're going to get a little more info on that today, Rick.
So it could be more like Japan.
Well, it's not.
You're not sure yet.
Well, we know they're not necessarily targeting a reserve level. Because I think they saw that was ineffective in Japan.
Well, I hope you're right, Steve. I'm not young enough for a lost decade here.
I think what Rick has been saying is what they're doing right now. They're just sort of backing away and let the market determine interest rates. I don't think they have a hard and fast goal.
Well,
that's different from that's very different from what Japan did, which specifically announced it was increasing from 4 to 5 trillion and then from 5 trillion to 20 trillion. Very different from what Japan did.
Sounds like Bob, who knows everything, is agreeing with Rick once again. So it looks like Leisman's probably wrong again. Anyway, thank you.
Joe,
hold on a second, Joe.
This was a very
Bob is not disagreeing with Rick because if what Rick is saying, he's just wrong about that, Joe.
Just stirring the pot. I was
just wrong about that.
I was focusing on something else. I don't even know what you were saying. Anyway, thank you.
Santelli wins. Okay.
Santelli wins. Bob McTeer, Rick Santelli, and the loser, Steve Leisman.